Hello, and welcome back to Everything Finance, where I help businesses get funding and startup businesses get funding, credit repair, business credit, real estate funding, commercial or residential, money strategies, and financial literacy. Now, for today's video, I will talk about our money market funds safe. Well, some investment strategies are more safe than others. Other assets like bonds provide a relatively low risk compared to less conservative assets such as option stocks or alternative assets. MMAs or money market accounts and similar investments alike that pay a higher return than a traditional savings account also offer lower risk. Just make sure you don't confuse these accounts with money market funds, which are completely different. Do your due diligence and learn about the differences between the two of them and how safe your money is with them. Now, the key pointers are as follows. Both money market accounts, MMAs, and money market funds, MMFs, are relatively safe investments. Second, MMAs are insured up to $250,000 per depositor by the Federal Deposit Insurance Corporation. Third, banks use money from MMAs to invest in stable, short-term, low-risk securities that are very liquid. And last, for money market funds, invest in relatively safe vehicles that mature in a short period of time, usually within 13 months. Now, what are money market accounts? Money market accounts are deposit accounts that can be opened at banks or other financial institutions like credit unions. They kinda act like a checking savings account hybrid, offering both flexibility of a checking account with the interest-bearing features of a savings account. They come with checking account features, meaning you can write checks, make transfers between accounts, and conduct debit card transactions up to a certain limit. Federal guidelines limit them to 6 transactions per month, after which you are charged a service fee for any more transactions after the legal limit. Also, money market accounts offer higher interest rates than standard checking or savings accounts. This makes them a great option for people who want to save for a major expense, like a vacation. Most financial institutions require deposits of minimums for most money market accounts. For instance, a bank may require you to open an account with a minimum balance of $25,000. You may be also required to maintain that balance each and every month. If you dip below that amount, you will generally be charged a monthly fee, so be careful. Important to note, a money market account is a checking savings account hybrid, while a money market fund is a type of mutual fund. Now, money market funds, this type of account is a type of deposit account. A money market fund is an investment vehicle, a type of a mutual fund that allows the investor to earn interest on cash reserves within a portfolio. That stray money left over from transactions or cash held until it can be invested in other vehicles. Instead of depositing money into an account, investors buy and sell funds, shares, or units. Consumers can buy shares through banks, mutual fund companies, or brokerage houses. The funds that pay dividends to investors based on short-term interest rates. So, investors who want to cash in their money market funds don't have the same options as people who hold MMA's money market accounts. This means you just can't write a check or make a withdrawal from your account, but instead you have to put in a request to redeem your shares. So that is the difference. A fun fact is fund companies must make payout within 7 days of the redemption request, just so you know. So, are money market funds safe? Well, for a short period, because they invest in low-risk investments and assets, meaning you are guaranteed a return. These include treasury bills and CDs, short-term meaning 13 months. Higher risk money market funds may invest in commercial paper, which is corporate debt, aka CDs, or foreign currency. These holdings can lose value in volatile market conditions or if interest rates drop, but they can also produce more income too, though. But again, do your due diligence because money market funds are not insured by the FDIC, Federal Department Insurance Corporation. They are required to comply with guidelines set by the Securities and Exchange Commission, or SEC. So, U.S. government money market funds are typically thought to be the safest kind of money marketing accounts. Among them are those that have a high concentration of treasury with the U.S. full government backing would be less exposed to difficult risk. So, can a money market account lose money? Well, as I stated earlier, it is a type of savings account that provides liquidity and earns interest on the principal. So you can't lose the balance of a money market account. However, penalty fees may be charged for falling below the account balance and withdrawal requirements. So for a money market fund, 6 to 12 months of living expenses are typically required for the amount of money that should be kept in these type of accounts. For unseen emergencies and life events, anything beyond that time frame, the money is essentially sitting and losing its value. So both strategies are relatively safe. One is backed by the FDIC money market accounts, and the other are not money market funds. So again, contact your financial advisor and see which one is best for you. Well, that concludes this video. I hope you have learned some things about both of these money vehicles and how you should be cautious about both of them because each has their pros and cons. So again, get up with your financial advisor to get professional advice. Thank you for watching, and I will see you on the next video. Take care.